Hey everyone, if you're new to investing and you know very little, if anything, about the stock market or how to buy and sell stocks, this video is for you. It is a simple, down-to-earth explanation of the key terms and concepts of stock market investing. I use plain English to explain all you need to know when you're first starting out in the stock market. I remember when I started out, when I was 15 years old, buying my very first stock, but more on that later. If I don't cover what you want to know, please leave it in the comments below, and I'll do my best to respond as quickly as I can. Please give a like to this video and subscribe to the channel if you're not already. Now, let's just jump right into it. So first off, why should you listen to me in the first place? Well, I think there's really two reasons. Number one, this is a free video. I'm not asking you to do anything. I'm not asking you to sign up for my course or any of that stuff. I'm not asking for any money at all. I'm just here to share what I'm passionate about, which is personal finance and investing. And secondly, I have a bit of experience in stock market investing and investing in general. As I mentioned, I've been investing since I was around 15 years old, and I currently am the managing director of a private equity firm with more than 1.4 billion under management. That's what I do full time, and I absolutely love it. In fact, back in undergrad at UCLA, I was part of the Undergraduate Investment Society, which, yes, that's an actual thing. That's how nerdy I am, but that is how much I love it. That's what I would spend my free time doing. So what then is a stock? Well, a stock is just a piece of ownership in a corporation. It evidences your ownership in that corporation. So if you own stock in a corporation, you are an owner of that corporation. That's a really important thing to note because, as we'll talk about later, if you're an owner, you're eligible to get money in your pocket because you're an owner. You're able to get dividends, payments. Later on, we'll talk about that. Stocks are simply ownership shares in a company. If you own shares in a company, you are a shareholder. That is why they're called shareholders, because you hold the shares of the company. Now, you can own those shares of the company, and you can also sell those shares of the company. You can also buy shares in a different company. This is done at a stock market, a marketplace where people can buy and sell pieces of companies with one another. Now, you only can buy and sell those companies that are publicly traded, that is eligible for the public to buy and sell. A publicly traded company is simply a company that elects to go public, elects to have its shares on the stock market to be bought and sold by other people. Let's say you have a lemonade stand in front of your house. Well, that would not be a publicly traded company. That's a private company because that company is not listed on the stock exchange. Some random person cannot purchase shares in that company without you knowing about it, without you contracting with that person. The vast majority of companies that you've heard of are publicly traded, such as Apple, Google, Adobe, Chevron, whatever it may be. Chances are those big companies are publicly traded, but not all of them. For example, Mars Co., the company that owns M&Ms and other brands, is not publicly traded. You cannot be a shareholder in that company unless you purchase it directly from that company, and it's extremely unlikely private companies will do that. The stock market used to be an actual place where people gathered and sold their shares of companies to one another. This is no longer really the case. There is a backdrop on CNBC of people running around on the floor of the stock exchange in New York, but that really isn't where the stock market does most of its business. That's not where most people buy and sell their stocks. Almost no people do it that way at all anymore. And why? Because you could do it free online now extremely easily by just opening an account at a million different places, from Robinhood, M1 Finance, and everywhere in between. You could do it instantly, and as soon as you buy and sell stocks, you're doing it electronically, not with a physical person anymore. You may have heard of the Dow Jones or the S&P 500 and have said, is that the stock market? Well, the answer is no, it's not really the stock market. It's just a part of the stock market. It's really just a collection of stocks organized in a way and branded as the Dow Jones, for example. It's really just kind of like a basketball team with a certain amount of players on that team. It's not the entire league. It's just a portion of the team. Let's take the Dow Jones, for example. It's by far the most widely followed stock index that there is out there. So many people say the stock market dropped by 800 points today. What they mean is the Dow Jones dropped by 800 points today. But the Dow Jones is only 30 stocks. It is 30 stocks and it changes over time, but largely stays the same. People follow it because it's been around the longest. The S&P 500 is 500 stocks, and it's a much broader, more representative look at the entire stock market. But again, it is not the entire stock market. It's only a portion of what is the broader stock market, which incorporates every single publicly traded company out there. Stocks are also known as equities, just like equity in your house, for the same reason too, because when you're an owner of a company, when you're an owner of stock in a company, you are entitled to whatever's left over after that company sells and pays off all of its debts, just like you would if you're the owner of your house. If you owe $100,000 on your house and your house is worth $250,000, if you were to sell that house, you would be entitled to $150,000. That is $250,000 minus the debt that you had on that house. The equity in your house is $150,000. The stocks that you talk about, that is known as equities because you have equity in the company in which you own the stock. So all this is great, but what does it mean to be an owner in the company? Well, if you're a stockholder, if you're an owner in the company, you're entitled to profits of that company. If you're a stockholder in Apple, for example, you're entitled to a portion of Apple's profits. Those profits can be realized in really three ways: dividends, share buybacks, or share price appreciation. Let's start with the dividends, for example. So dividends are simply payments to the owners of the company, and they usually occur on a quarterly basis. This really was one of the most surprising things for me when I bought my very first stock when I was 15. That was Verizon Company. At the time, Verizon paid a 6% dividend yield. A dividend yield is simply the amount of cash that a company pays you on an annual basis divided by its share price. So let's slow that down. An amount of money paid by a company on an annual basis. So usually the companies pay on a quarterly basis. So if you add up all those quarters in a year, that is the total amount of money paid to you. Let's say that Verizon was $100 per share at the time I bought it, and it paid a 6% dividend yield. That meant that I got $1.50 every quarter. That is 4 quarters times $1.50. That's $6 a year. $6 into 100, that is a share price, is a 6% dividend yield. It's an amount of money you get just for owning the company. It's like interest on your savings account, except it actually is material. It is pretty awesome to get just for holding the company. You don't need to sell your shares in order to get money from the company if they pay a dividend. Now, not all companies pay a dividend, but those that do usually pay it on a quarterly basis to those people who own their shares of the company. The second way you could earn money is by a share buyback. So a share buyback is when the company itself purchases back its shares that are on the public market. So it dilutes the amount of outstanding shares out there, meaning whatever the company is producing in profit later on is divided among a smaller amount of mouths to feed, if you will. So if you have a company, let's keep it simple, that has 120 shares outstanding, 120 shares available, well, that means that if the company buys back 20 shares, there are now only 100 shares remaining. And if that company made, for example, $100, well, before it was distributing $100 amongst 120 people, now it's only doing so among 100 people, meaning your earnings per share goes up, the value of your share price goes up because the company bought back shares. The third way to realize increased profits as an owner of the company, as a shareholder of a company, is with share price appreciation. So share prices are the prices of the stock that other people are willing to pay you for your shares of the stock. That is what you see online when you look up a company like Apple, for example, and you look up Apple stock and it shows it as $175, for example. All that means is the price of the share that a true buyer and seller are willing to transact on that very day. It goes up and down over time, and generally the price of a company will go up over time if the earnings of the company increase over time. So if you want to get started with investing, I recommend using any online platform which is free. I've used many of them before, and I currently primarily use M1 Finance. There's a link below. You don't need to use it but if you choose to do, I think you get around $25 or $50. It always changes as a bonus if you deposit a small amount of money into that account. That always helps get your account going. It's pretty nice to have. So I thought I'd throw that out there. Link in the description below. So let's talk about the share itself, the shares of a company itself, and some common misconceptions. So first off, the share price of a company does not directly equate to the value of a company, meaning if a company has a higher share price, it is not necessarily more valuable than another company with a lower share price. Now, why is that? Well, it all comes down to the amount of shares outstanding. So if you have two companies, for example, and one of them has 100 shares outstanding and another company has 200 shares outstanding, and the 200 shares are trading for $1 each, the total value of that company, the market capitalization of that company, in other words, is $200, because you take the number of shares, 200, multiplied by the share price, $1. Now you take that other company, for example, and let's say its shares are also trading for $1. That means that that company's market value, the market capitalization, is only $100 because it only had 100 shares outstanding. Those 100 shares multiplied by $1 means the total market capitalization of that company is $100. This is not the same between the two companies, even if they have the same share price, because of these shares outstanding. Generally speaking, if you want to know the value of a company right away, you just look up the market capitalization of that company. Apple, as of the date of this video, has a market capitalization of around $3 trillion. That means the amount of shares outstanding that they have, which is in the order of a couple billion shares, multiplied by their current share price of around $170 plus dollars per share, means that they have a market cap of $3 trillion. I also want to make a point about stock splits. You may have heard about a stock splitting, 4-to-1, 7-to-1, whatever it may be. Tesla recently did this. Apple's done this recently. That means that the shares of the company split and actually become two shares, but nothing actually increased in value here. Imagine a pizza, for example. Imagine you had a pizza and you divided it into 4 slices. And then I came along and I said, we're going to split the slices. We're going to split these shares of pizza into more shares. And I simply cut across the pizza and now there are 8 slices. You wouldn't say, oh, terrific, there's more pizza for everybody now. It's the same amount of pizza. It's just divided among a few more additional shares. That's all a stock split is. That's all that really happens in a stock split. Remember, the value of a company is simply the amount of shares outstanding multiplied by its share price. So that brings us to, how do you value a stock? How are stock prices determined in the first place? How are market capitalizations of companies determined in the first place? Well, it all boils down to 2 things: the earnings of the company and the multiple that people are willing to pay for those earnings on the company. So let's slow it down. The first part is pretty straightforward: the earnings of a company. All the earnings of a company are the company's expenses made in producing revenue and the revenue of that company subtracted from one another, and whatever's left over is your earnings of the company. So let's go back to the lemonade stand. Let's say lemonade was sold. It was a really hot day and a bunch of lemonade was sold, and it cost $50 to make that lemonade because you had to buy the lemons and the sugar and everything else. And you sold it and you made $100 of revenue. Well, that $100 of revenue minus the $50 of expenses leaves you with $50 of earnings for that lemonade stand. Every company out there reports earnings on a quarterly basis for the most part. And when you're looking at the earnings of a company, you're going to look at it at an annual basis, whatever they made over the course of the last year. Those are the earnings of the company. So what then is the multiple? The multiple is the premium that people are willing to pay for the stream of income of those earnings. And the premium that they're willing to pay goes up and down depending on what kind of business it is and how long you've actually been able to produce those earnings and what level of risk there is of those earnings going down over time. So a multiple is a risk factor. So if you have a higher multiple, that means that you're going to be willing to pay more for that company. That company is probably less risky or has more growth prospects. If the company has a lower multiple, that means that company is either more risky or has lower growth prospects. Look at General Mills, for example. They make cereals. There's not a whole lot of growth in technology in cereals. You pour it in a bowl, you eat it, that's pretty much it, and that's pretty much how it's always going to be. Therefore, the multiple of the company is 18. General Mills has a multiple today of 18, meaning the earnings times 18 equals the market cap of the company. Apple, for example, is a much higher growth company, a company that in the future, it's unlikely they're going to have a decrease in earnings. Therefore, it is less risky and has a higher multiple. The multiple today is around 31. That means 31 times their earnings gives you $3 trillion, their market cap. Stated simply, the market cap of the company divided by its earnings will give you its multiple, or the share price of a company divided by its earnings per share will give you the company's multiple as well. Generally speaking, the S&P 500 has a multiple of around 20. It's gone up and down over time. That means the average of all the stocks in the S&P 500, a very good broad gauge of the market, has a multiple of around 20. That means companies with a higher multiple are those companies that people think will grow faster or are less risky than those companies with a lower multiple than 20. So let's talk about how share prices can increase over time. There are three ways a share price can increase over time. Number one, the earnings of the company can go up. Number two, the multiple of a company can go up. Or number three, both the earnings and the multiple of a company can go up. The opposite is of course true. If they go down, the share price will go down as well. When share prices go up and down every single day, that's because everybody around the world is calibrating the amount of risk of that company and the amount of likelihood that company's earnings will increase or decrease over a period of time. Every single day, everybody is saying, I think Apple's going to sell this many iPhones or that many iPhones, and therefore it's going to earn this amount of money. And because it earns that amount of money and it'll report that in a few weeks, I think the share price should be higher because the earnings that it had before were lower than that, and the multiple might stay the same. That's why share prices go up and down over time. And there's a million factors at play all the time as to why share prices go up and down, because again, it all boils down to how much money is that company going to be earning and when is it going to be earning that money. A few other things about price to earnings multiples: it is not the end all be all of stock analysis. It is simply the bedrock foundation. There's many other factors that go into play in analyzing a company, such as how much company cash does the company have on hand, what is the growth prospect of the company over time. But again, all this is usually wrapped up in the multiple of the company, the price premium that people are willing to pay for the earnings of the company in the future. A company that has a huge growth potential that everybody can see is going to have a much higher multiple. For example, Tesla is a company that doesn't earn very much money right now relative to its enormous market cap, but it is a company that most people expect will earn a ton of money in the future and therefore commands a much higher multiple even if the earnings are not there, therefore justifying a current market cap of a lot higher and a share price of a lot higher than it would be if it were, for example, General Mills. So that really is your basic overview of the stock market, and I know there's a lot more to it, but I wanted to give you the overview because it can be overwhelming if you come into it and you think that there's all this crazy stuff. You see people on TV yelling and screaming, and just don't worry about it. All you need to know is if you save your money and you put it into the stock market more times than not, you'll probably do okay. I'm going to make a follow-up video on how to specifically identify good companies to buy and how to buy them at a low price and hopefully have them grow over time so that your money can grow as well. I've had a lot of experience doing that. I've had companies where I purchase for an amount of money and it's gone up by 20 times, for example. That doesn't happen all the time, but it can happen for you, especially if you're patient and your time horizon is long enough. So again, if you want to get started with investing, look at my link below. I have a link for M1 Finance, a company that I use to invest with stocks. I actually deposited some money there a couple years ago and I've been really happy with it. You get a bonus for signing up. I don't know exactly what the bonus is because it changes all the time, but I thought I'd throw that out there. You don't need to use it, just thought I'd throw that out there. And please give a like to this video and share it with your friends if you want to. If not, no big deal. Leave a comment below if you have any questions at all, and I'll see you next time. Thanks.